One thing I hear about whole life insurance all the time is that it is a ripoff. However, I heard from someone recently that they expressed whole life insurance was a ripoff in the past, but they just started a policy where they're putting away $1 million. Why? Why would someone go from the side, whole life insurance is a ripoff, to I want to put $1 million into a policy? I'll explain why. So this is actually an engineer couple. They have extreme attention to detail. The wife's occupation at her company is referred to, or the job title is called an engineer specialist. So they really dig into the details. They did when I connected with them, which I appreciate a lot. What they are interested in about whole life insurance was not the life insurance. It was purely the cash value. Specifically, that they could grow their money safely, regardless of what's occurring in the stock market, the economy. They like the fact that their money goes nowhere but up over time. And then also, the tax advantages were very appealing to them. Meaning, if you follow IRS rules and your agent does everything right, you can easily access the cash value on a tax-free basis. And they're interested in that specifically for supplementing income during retirement. Now, here's the thing. They had looked at whole life insurance in the past, and the husband expressed to me over the phone that he thought it was absolute junk, like no interest in the product. And he said, we had zero desire to do it, and I probably would never do it again until I really got to take a look under the hood and see how it works. Being an engineer, he wanted to understand it. What he didn't like before though, why he thought it was junk. First, a 50% loss in the first year. Sometimes it's a 100% loss in the first year. But the idea of putting a large dollar amount into a policy and having 0 or 50% of what you paid in there immediately, he said, no, not worth it. And then second, taking 10 years just to get his money back, he's like, that is way too big of a lost opportunity cost. I don't care how safe it is. I don't care what the tax benefits are. If I have to take a 50% haircut up front and wait 10 years just to break even, let alone see any type of positive cash value, it's not worth it. And I agree, it's not worth it in that case. So I'll show you exactly what he did. First, his situation. So him and his wife do very well. Here are their assets that exclude any illiquid assets, such as a business or real estate. They've got about $600,000 in cash, more than $1.6 million in stocks, about $1.8 million in retirement accounts. They do have a Roth IRA, but it's small, especially compared to their other assets. They've got about 40 grand there. And their annual income is about $300,000. Now notice, in those assets, we did not include any real estate, which includes their home. We're not including that here. When we look at their debt, they've done a good job. They've got a mortgage. It's fairly low when we look at it compared to their overall assets, $225,000. They've got a car loan and some other small debts, about $25K. So total debt is $250,000. So very healthy financially. So whole life insurance. They'd heard about people using it specifically to grow their money safely, and then also utilizing the tax-free benefit during retirement. That's what helped them explore it again, because they looked at it in the past and it was, I don't care about this, but now they're exploring it again. All right, the target amount, as far as how much money they want to put into this policy, actually how much they are paying into the policy they just started, $1 million. What we looked at are 3 different scenarios. I'm going to show one product, which is actually the product that they like the most. And what we had shown them, which was funding that $1 million over 10 years, over 7 years, and then also over 4 years. And we'll look at which one gives you the highest return, meaning the most cash value, short-term and long-term. And then I'll also let you know which one he was most comfortable with and which one he ultimately decided to move forward with. And what I'll also add is the policy is on his wife. The husband has some health issues that I don't feel are major. I do feel that we would be able to get him a policy, but he said, I'd like to look at my wife. That's just what I'm comfortable with. So here's our illustration. What we've got here are our guaranteed values. And then we've got our current values here, which is based on the current dividend interest rate of 6.10%. That's what we're going to look at in this example because we are with Guardian, one of the major mutual companies. I track the actual performance with Guardian whole life insurance policies, really with all whole life insurance policies that we put in force for everyone. And I do see them deliver. In many cases, spot on with what is illustrated in the event of a dividend rate adjustment or something like that. So here's an example that shows a total of $1,020,000 going into a policy over 10 years because you wanted to start with a little bit more than 100 grand in the first year. By the 10th year, he's got just over $1.2 million in cash value. So let's take a look at this on Excel, shall we? This is the exact same illustration we just looked at. Firstly, what's his first year cash value? Does he take a 50% hit? No. He pays in 120. He's got 105, almost 106. So he's between 85 and 90%. He's closer to about 87% and change in that particular example. So very cash-rich policy right out of the gates. When is his break-even point? Is it 10 years just to get his money back? No. When does he get his money back? By the third year, he's paid in 320. He has 315. And by the fourth year, he's paid in 420, and he has 425. So by year 4, he has a positive cash value relative to what he's paid in. This is the 10-year funding scenario, and by the 10th year, the cash value is 1.2 million, and by the 20th year, the cash value is almost 1.9, $1,880,000 and change. Okay, let's look at funding it over 7 years. Here we go. What do you notice? The funding we looked at was $165 per year for 5 years, then year 6, 150, and year 7, 25. So we get to total of $1 million into the policy, 20,000 less than the example to the left. But even with putting less in, by the 10th year, he's got almost $50,000 more, 1.25 million and change. And by the 20th year, look at that, 1.95 million. So he's got about a $70,000 increase, about 75 almost actually, by year 20 with the exact same product, just by funding it in a shorter period of time. What if we look at 4 years? Well, it gets even better. It's fun stuff, right? So here's your 1 million over 4 years, 4 level payments of $250,000. That's it. No, I know that's a lot of money. What I'll add about this is the minimum in this example is about 25,000. So it is set up where it's very, very flexible, meaning he doesn't have to put in 250 every year. The same is true with this example. The minimum is about 12K, and with this one, it's close to about 17K. So he can easily commit to the minimum and add more at his discretion. I don't want to make it seem like 1 million is a small amount. I know a lot of times folks do reach out to us and say, hey, can I do this with 2,500 to 25,000 per year? The answer is yes, we can design it very, very similar. But in this example, by the 4th year, you're cash positive. By the 10th year, 1.3 million. And by the 20th year, $2,050,000. So we're seeing a significant increase here. And if we actually condense this over 3 years, at her age of 47, it would look even better. If we condense it to 1 year though, or 2 years, it's not gonna look quite as strong as 3 years. 2 years would be okay, but 3 years will look the best for her at her age. So which one gives you the most cash value? The 4-year option. We showed him these 3. Which one do you think he picked? Meaning, which one was he most comfortable with? Even though this one had more money, he picked this one. Why? If you saw whole life insurance in the past and it wasn't good, and you've heard horrible things about whole life insurance from your peers, other influencers, large companies online, people in the financial services industry that say, don't put money in whole life insurance. And then you see something that looks very, very good. And you see the guaranteed values, like we looked at earlier. You see the non-guaranteed values. Some guy like me is showing you proof. Look, here's policies from the 1970s, 80s, 90s, 2000s, as we have all of that. But still, you have conflicting information. Would you dive in to this option? Now, if you say yes, would you advise someone else dive in when they see one good thing and they've heard 5 bad things? Probably not. The question is, how comfortable would you be with it? That's the question we asked earlier. So we started with the option where he funds it over 10 years. He actually just started this policy for his wife. If he wants to get another policy later, as he gets more comfortable with it, he easily can. But I do like the fact that he started with where he's more comfortable, because if you go with the option that looks the best, yes, it's going to deliver. Like I've always seen them deliver. But if you're losing sleep at night, just doubting it and always looking at it all the time, it kind of takes the joy out of it in some ways. I know that might sound weird, but stretching is good. But if we stretch too much to the point where it's uncomfortable or we lose sleep over it and causes us unnecessary stress, it's okay to start a little bit more conservative, get comfortable with it, and then maybe look at a second policy later where you start more aggressively. Anyway, that's what he did. I hope you enjoyed this video. If you have questions, thoughts, comments, anything, please feel free to leave them in the comments below. If you would like to connect, you can visit our website, ibcglobalinc.com. You can also DM me on any of our platforms. I do like LinkedIn. A lot of people reach out. If you'd like to check out our book, it's coming out in the near future. I'm so excited for this thing because I've been working on it forever, as it goes over all the details about cash value life insurance, and it also shows models as far as how wealthy clients of ours have used whole life insurance. I included an example of the bank we work with that has purchased cash value life insurance multiple times. So you can see exactly how banks use cash value life insurance, and also how small businesses use cash value life insurance, and a whole lot more. I did include a lot of technical detail in here, but I'm excited because we got the hard copies less than a week ago, actually. And we'll have it in paperback and also a hardcover as well. Anyway, hope this helps. Thanks so much for watching all the way through. Enjoy.